Powell just spoke. Here is what Jackson Hole means for your investments. The wait is over. Just hours ago, Federal Reserve Chairman Jerome Powell delivered his highly anticipated speech at Jackson Hole. The question on every investor's mind was simple. Would he signal a rate cut? Well, he just did. Here's a quick breakdown of what Powell said, how the market reacted, and what the biggest players on Wall Street are saying. The key takeaways, the big news is this. Powell opened the door for a potential rate cut as soon as September. He acknowledged the Fed is facing a challenging situation with two conflicting forces at play. As he put it, risks to inflation are tilted to the upside and risks to employment to the downside. First, the labor market. While it has been slowing down, he described it as being in a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. He went on to say that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. Second, inflation. He pointed out that the effects of tariffs on consumer prices are now clearly visible, adding that we expect those effects to accumulate over coming months. He addressed the critical question of whether these price increases would become a long-term problem for monetary policy, and offered a balanced perspective. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. However, he also added a crucial caveat. Of course, one time does not mean all at once. This is a huge deal. It shows that despite continued political pressure, Powell believes the risks to employment are now significant enough to warrant a change in policy. As he said, the shifting balance of risks may warrant adjusting our policy stance. The market's verdict. So how did the market react to this new information? It reacted exactly as you'd expect. Stocks. The S&P 500 surged, gaining over 1%. While the Nasdaq also saw strong gains, the market viewed Powell's comments as a dovish signal, increasing optimism for a rate cut that would boost corporate earnings and economic growth. Bonds. The bond market saw an immediate rally. Yields on U.S. Treasuries tumbled, which is a sign that bond investors are anticipating lower interest rates and reduced borrowing costs across the economy. The U.S. dollar. The dollar weakened against other major currencies, a typical reaction when the Fed signals it may cut rates. The market has now priced in a near certainty of a rate cut at the next FOMC meeting in September. According to the latest data from the CME FedWatch tool, the probability has jumped to well over 85%, up from about 73% just a day ago. What the heavyweights are saying, but what do the biggest players on Wall Street think about this apparent shift? According to an analysis from PIMCO, a global investment management firm, the market's strong reaction was due to the surprisingly explicit nature of Powell's dovish comments, focusing on rising employment risks. Analysts from across the board at institutions like Goldman Sachs echoed this sentiment, viewing Powell's words as providing the Fed with sufficient justification to initiate easing in September. Deutsche Bank's chief U.S. economist went even further, stating that Powell's speech was more dovish than we expected, and they now anticipate a series of rate cuts starting in September. Interestingly, while the immediate market reaction was bullish, Vanguard highlighted that Powell's measured approach represents a notable shift in the Fed's policy framework, away from its previous average inflation targeting strategy. The consensus among these heavyweight investors is clear. Powell has signaled a likely rate cut, but the ultimate decision hinges on the upcoming economic data. What is next for your portfolio? So what does this all mean for you as an investor? The immediate risk of a major market downturn from a hawkish Fed has subsided for now. The focus has now shifted entirely to the incoming economic data. The Fed has made it clear that its next move is not on a preset course and will depend entirely on what the data shows. This means you should be watching two things very closely over the next few weeks. The next jobs report, to see if the cooling trend continues, and the next inflation data, to see if the tariff-driven price increases are indeed a one-time blip. These data points will either confirm the market's current expectations for a September cut or challenge them, potentially leading to more volatility. Conclusion: in short, Jackson Hole has given the market exactly what it wanted. A clear signal for a potential rate cut, But the journey isn't over. The next few weeks of data will be just as crucial. I'll be here to break down every piece of it so you can stay ahead of the curve. If you found this analysis helpful, please hit the subscribe button and join our community. Thanks for watching.